inflation rates have been relatively well behaved over the past 2 years, and inflation expectations have been trending down. But what are the implications of these developments for fixed income investors? Joining me today to unpack this issue is Fund Manager Duayne Le Roux.
Thanks for having me, Audrey.
So Duayne, 2025 was another good year for South African bond investors. Can you share the drivers for performance over the last year?
Awesome. Yeah, good years, putting it lightly. I think last time we checked, the ALB ended about 24-25% up. And in the year before that, 17%. So it's been two phenomenal years in terms of bond performance. And yeah, I think there were a few years ago, it had been touted that at the valuation levels where they were at, South African bonds were kind of labeled as potentially having equity-like returns, and it seemed like a faraway concept. And if we look at how the last 2 years turned out, more or less turned out in the way that, that initial, call it prognosis, initially was stated. But if we think about last year particularly, I harken back to the beginning of the year, and everyone likes to anchor towards the end of the year and how it ended. But if we think about how the year started, there was a significant amount of pressure that our bond market had to absorb. We think about the tariff regime change that happened in the US and how fundamentally how that fundamentally changed the, call it, economic landscape globally. We also think about our local developments, what happened with the budget, and these early, call it, growth pains within the GNU. Our bond market had to absorb quite a lot last year, and so during that period, it's incredible to think of where we ended up and being so strong. And we think about the key drivers thereof, as you mentioned. Definitely, we saw this political environment, local political environment, galvanize to an extent. We saw the budget being passed and further support for the institution that is the Treasury, which is, as bond investors, it's absolutely critical. Furthermore, the initial expectations for what a new or different changing tariff regime might look like, these initial expectations were quite dramatic and quite drastic, and we were able to see just how the global economy would be able to absorb those and our own as well without having the necessary fallout that their expectations were once at. But by far the biggest driver in terms of our local bond market and the return dynamics have been the changing dynamics with regards to inflation. We saw, as you mentioned, inflation expectations drop almost 1.5% during the course of last year. And for bond investor, where inflation is such a critical component or return component, that changing dynamic really helped to drive and to steer bond returns throughout the year. So to a large extent, we owe it to the changing inflation expectations, and where they are right now, it's appropriate to review those expectations.
Lower inflation expectations have aided performance, but what should fixed income investors bear in mind looking ahead when it comes to constructing their portfolios?
Awesome question. And we're getting asked this quite a lot, especially after the last 2 years. Definitely at this point, especially within fixed income, you've got to cover the basics. We think about delivering cash plus returns, but more fundamentally than that, the inflation beating returns. We see that as being fundamentally core to what investors need to be looking out for. And then another key pillar to that is being able to achieve or meet these hurdles, these targets of cash and inflation plus, but at low levels of risk. And risk within the fixed income context, as we've spoken about previously, really is being able to avoid that permanent capital loss. So making sure that those who we are entrusting with, our clients' capital are able to hold them to a very high standard, and they must be able to adhere to that standard. And being able to avoid permanent capital loss is so crucial. And then there's another element to the risk. The risk dynamic is being able to deliver the fundamental returns in what we can characterize as a potentially changing environment. So at the moment, inflation expectations are low. There's a lot of weight of credibility being thrown behind the SARB and the changing mandate, the changing target, and we feel that as an institution they're incredibly strong and fundamental behind, bond investors being able to anchor returns to. But if we think about the potential for change, there's a lot that could happen. There's a lot that we like to say, there's a lot that can go wrong, and there's a lot we don't know. So we want to be able to make sure that, especially for fixed income investors, portfolio robustness is absolutely crucial right now. Anything can happen, anything can change, and we want to make sure that portfolios are able to withstand the potential, therefore, going forward.
Inflation-linked bonds are typically instruments that investors associate with a higher inflation environment. And yet PSG Asset Management is currently finding attractive opportunities in this space. Can you explain to us why?
Thanks for asking, Audrey. So we go back to our principles. What are we trying to achieve for fixed income investors? So fundamentally, we like to outperform cash and inflation at low levels of risk. And with inflation-linked bonds, they offer a unique opportunity to achieve all of these at very attractive starting points. If we think about where the market is at the moment, the starting real yields, they're around 4.2%. What that means practically is from this point forward, in inflation-linked bonds, you're guaranteed inflation, whatever that is, plus 4.2%. And for a fixed income investor or a low risk investor, we think this is an incredibly great starting point. If we take into account the fact that inflation-linked bonds as a whole have significantly lagged behind the performance of the fixed rate nominal bonds, which returned the 24-25% of last year, we think there's potential for them to catch up in a sense. And if we think about combining those dynamics, the potential for inflation to deviate from these really accommodative starting points in terms of expectations, the starting real yield that's very attractive, and the potential for capital gains that would come with these inflation-linked bonds catching up, so to speak. We think that as an asset class, there's a really attractive opportunity that ticks all the boxes in what we like to think is a low-risk fashion for fixed income investors.
Duayne, many investors associate a lower inflation outlook and lower interest rates with less attractive returns from fixed income investments. But we all know that for an investor, it's all about the real return, and that's what really matters at the end of the day. So what should investors be bearing in mind when it comes to their fixed income portfolios with these factors in mind?
Thanks, Audrey. It's really good to have that perspective and just put things into a broader perspective. We mentioned earlier, not getting sucked in or carried away. For investors at home, I would really encourage them to think about the role that fixed income is designed to play in a portfolio. You mentioned carrying the real yield kind of anchor within a portfolio and not necessarily getting sucked into having it deviate too far from that. And if we think about from the institutional side or the side that we sit in, we really anchor back to process. Fixed income, low risk investors. What are we trying to achieve? We're trying to beat cash and inflation at low levels of risk, and that's what fixed income is fundamentally but fundamentally there to do. And where we look out from this point, the start of 2026, over the rest of the year, starting valuations, we see great potential for that from different parts of the market. Yes, nominal bonds have performed well, or fixed rate government bonds have performed well, but at low and stable inflation, there's no reason to say that they can't continue to perform well, not necessarily at the high double-digit numbers that we were seeing over the last 2 years, but in a manner that meets those objectives of beating cash, beating inflation, while still maintaining low levels of risk. And then we're looking for robustness. We want to build the most robust portfolio to be able to deliver on those promises with in the most varied of circumstance, we could say that. So in environments where inflation potentially turns out to be different to what is largely expected, we want to make sure we're able to deliver for clients in that environment. And that's what it's about fundamentally. So we think there's great opportunities within fixed income. If we look at the outlook from this point, we encourage investors to think about the role of fixed income in their portfolios. And yes, from our side, we're trying to, as best as possible, stick to our process, keep in mind the promises we've made and deliver on those with relentless focus.
Duayne, it's been great talking to you. Thank you so much for joining me today.
Thanks, Audrey. Thanks for having me.